Some people are not emotionally or psychologically prepared to invest in stocks, but I believe if you educate yourself on what you're really buying, you'll find that more of them will be. Mr. Warren Buffett, the world's best investor, says it's all part of the business. He took over Berkshire Hathaway in 1965, and the stock has returned an average of 20% per year since then. That is more than double the annual return of the S&P 500. Berkshire has a total return of 2.8 million% over time, compared to the S&P's meager 23,000. And he's done it by adhering to a very simple set of rules. First and foremost, we must deal with things that we can understand. Next, once we've passed that filter, we must have a business with some intrinsic value that provides it with a long-term competitive advantage. Then, of course, we would much rather have management with a high level of integrity and talent in place. Finally, no matter how fantastic it isn't worth an infinite price. So we need a price that makes sense and provides a margin of safety in light of the natural business tides of life. It's a very basic set of concepts. And the reason our ideas haven't spread faster is because they're too simple. It's a 4-step process. And as I mentioned at the beginning of the video, this approach never changes regardless of market conditions. So whether the title of this video was Buffett's Advice for 2022 or Buffett's Advice for 1988, these 4 investing foundations would always be the same. Although, without a doubt, we have some tough additional factors to negotiate with our investing this year. We're dealing with absurdly overvalued stock markets, high inflation, and the likelihood of interest rate hikes this year. As a result, there is inflation. Warren Buffett discusses each of these 3 key factors in one video clip, and we begin with the issue of overpriced stock markets. How can we invest this year when everything is so costly? If you're an active investor, chances are you won't have many opportunities to acquire undervalued stocks within our area of expertise this year. In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will own permanently, Warren said in 2019. However, the immediate prospects are not promising. Prices for businesses with good long-term prospects are now sky high. Yes, Buffett is attempting to acquire entire businesses, whereas we are attempting to acquire a few shares. But at the end of the day, it's all the same thing. And without a doubt, he has had a difficult time finding places to invest his money in the last year or two. But he doesn't just waste his money on overpriced stocks, does he? That is a cardinal investment sin. Instead, he just keeps accumulating money and waits patiently. Berkshire Hathaway's cash reserves has grown from $84.4 billion in the third quarter of 2016 to $149.2 billion in the third quarter of 2021. So it's far from ideal, but keep in mind that you don't make money when you buy or sell. While you wait, you earn money. Wait for the right opportunities to present themselves, and resist the temptation to buy average investments in an overpriced market. Remember, as Buffett says, you don't need that many great stocks in your lifetime, but 3 great businesses is more than you need to do very well in this life. You don't need a lot of wonderful investments in your life to succeed, so be patient until the market provides you with one. That is, unfortunately, the reality of active investing in 2022. However, there is another investing tactic that Buffett frequently suggests for most people, which is passive investing. And passive investors who are simply dollar cost averaging and investing in the stock market should continue to do so in 2022. It's not about trying to time your investments perfectly. The dollar cost averaging strategy requires you to continue buying market tracking investments at the same time intervals, rain, hail, or shine. And if you do this for decades and decades, you will get the market's average return. And, by the way, it's about 8 to 10% per year. So we choose a broad index but not throw a large chunk in it at once. We would do it over time because the very essence of index funds is that we are predicting that America's economy will perform reasonably well over a long period of time. But we don't know enough to predict the winners or the winning times. Nothing is wrong with that. We occasionally believe we know enough to pick a winner, but this is not very often. And certainly we can't choose winners by going through a list saying, this is a winner, this isn't, and so on. So, if you have an overall feeling that a business is a reasonable place to have your money over a long period of time, the important thing to do is to invest over a long period of time. and not make any implicit bets by putting a large chunk in at a given time. Don't worry about the market being high or low if you're a passive investor. Never read a headline, just keep going. Never ever look at a chart, simply stick to your plan. If you have a long-term mindset, the stock market will be your friend. Even if you've invested everything and the market crashed 50% the next day, long-term passive investors would be fine. It only took 5.5 years to recover from the GFC, the world's worst financial crisis since the Great Depression. And 9 years later, the market has nearly tripled since then. So, while the market is currently high, it is not the end of the world. As active investors, we must be patient and avoid making rash decisions. And as passive investors, we must continue as before. Just keep aiming for it. But what about inflation next? That has been a big story over the last year, and rightly so. In the United States, annual inflation has reached 6.8%, and inflation is expected to be a major story in the coming year. You can't just do one thing in economics. You must be curious and ask, and then what? And lo and behold, zero interest rates and money printing have finally caught up with us. Inflation is on the rise. So what are we going to do about it? Buffett has actually explained this one a long time ago. We're going back to 1982, when US inflation was just beginning to fall after reaching around 20%. In his annual letter to shareholders in 1982, Buffett outlined the types of businesses that should be purchased during inflationary periods. Warren Buffett carries on talking about companies that can raise prices with no repercussions. That certainly helps to mitigate the effects of inflation. But what company could raise prices significantly without losing market share? People would almost certainly look for a cheaper product elsewhere. Apple constantly raises their prices higher than the competition, with no consequences to their market share. Coca-Cola raises their prices, people do not switch to other drinks. And, ironically, they are two of Warren Buffett's largest investments. Right now, the most important thing to do during inflationary periods is to ensure that the companies you're considering have a competitive advantage, something that indicates that they will retain their customers and, as a result, even if they raise prices, they will maintain their market share. Second, Buffett says we should look for businesses that can handle a large dollar volume increase in business with only minor changes in capital investment. So basically, companies that can generate a lot more cash without spending a lot of money to do so. This simply means that you should look for companies with highly scalable business models. You are aware that Facebook does not require the development of a new app to increase ad revenue. They only need to increase the frequency of their advertisements. In contrast, if Ford wants to double its revenue, it must construct new facilities and factories or hire more workers to produce more cars. That is a much more difficult task. In times of inflation, look for that competitive advantage as well as companies that can be easily scaled. Finally, let's discuss interest rates. The Federal Reserve has stated that it's considering 3 interest rate hikes in the coming months. Because interest rates are at zero, big money managers simply aren't making money on bonds. As a result, money that would normally be invested in bonds finds its way into the stock market in search of higher returns, driving up valuations. Interest rates are like gravity to stock market valuations. The less gravity there is, the easier it is to jump. However, increasing gravity makes it much more difficult. The stock market is the same way. We are currently experiencing ultra-low interest rates, which means that stock market valuations can easily rise. However, it appears we are heading in the opposite direction this year. Interest rates will begin to rise, and the higher interest rates rise, the stronger gravity pulls, and the more difficult it is to jump. While you should never let the macroeconomic environment influence your personal investing, it's worth noting that valuations may come under pressure this year through 2023 and beyond, especially for overvalued stocks, as new bonds become more appealing and interest rates rise. So no end of the world forecast, but be aware that this is a possibility in the coming years, so be prepared. That's all we have for today. If you'd enjoyed the video, why don't you give us a like and subscribe to our finance channel. Don't forget to hit the bell button below to get notifications on when we'd post next. Thank you for staying till the end of the video and hope you enjoyed. See you next time.